Hi everyone, Alex here from Summerhill, just with another quick update. Today's update covers the government's recent announcement. They will be extending the 50% reduction to minimum pension payments until June 2022. And a quick update on what we have been doing with the defensive portion of client portfolios this year and how it fits into our current thoughts on markets. Now, firstly, for those of you who draw an income from your superannuation, given COVID's negative impact on investment markets in early 2020, you may recall that the government introduced a temporary 50% reduction in the minimum amount members were required to withdraw from their pension account on an annual basis. The temporary reduction was expected to finish on 30 June this year, but has been extended until 30 June 2022. For some, it may be advantageous to continue drawing the reduced minimum pension amount from your account from July this year, as it will allow you to maximise the amount retained in your tax-free pension account. For our clients, should the changes impact you, we will contact you directly in July to confirm your new minimum pension payment amount for the 2021 financial year and provide a recommendation on adjusting your pension and cash flow strategy to best take advantage of the temporary reduction to the minimum pension payments. Now, moving on, we just wanted to cover off on what we are and have been doing with the defensive side of client portfolios to help maximise overall returns in this low interest rate environment, while also ensuring that we're not taking unnecessary risk with the defensive side of the portfolio. Now, depending on our specific clients' goals and circumstances, in 2019 and early 2020, many of you will have noticed a reduction in the amount of bonds and a higher amount of term deposits being incorporated into your portfolios. This was effectively due to research showing term deposit rates were paying a premium to government bonds, and it was viewed that government bonds were carrying a heightened level of short-term risk. Now, the first quarter of 2021 was a different story, with the premium on new term deposit rates diminishing as interest rates reduced. And there's been a repricing in bond markets, which has increased the expected returns now for government bonds, making them more attractive than term deposits. We're using the repricing in bond markets as an opportunity to reduce term deposit exposure as they mature and increase exposure to government bonds and investment grade bonds where appropriate, with the aim of enhancing the longer term expected returns for the defensive allocation of client portfolios, while also providing security, liquidity, and investments that provide returns which are low or negatively correlated with shares to help manage the overall volatility in the portfolio. Now, given the low interest rate environment, if we do want to get positive real returns and genuine long-term security, we do need to accept some volatility in the secure portion of portfolios. And with bonds, particularly investment-grade bonds, there is a greater potential for fluctuations in the value of those investments. Now, different types of investments and security meet different portfolio needs. And again, depending on our clients' specific goals and circumstances, we are building secure portfolios using a three-box framework, whereby investments are spread across cash and term deposits. And this is for short-term cash leads, and it provides a secure component to your overall portfolio. Now, even though interest rates are low, this is still a vital portion or part of your overall portfolio. As we saw in early 2020, share and property markets can reduce quite quickly in the short term. So cash provides security and certainty to meet short-term cash flow needs without having to sell share and property investments at unfavourable times. Cash also allows you to draw on cash while share and property markets recover, and to use cash to rebalance the portfolio and purchase shares at lower prices during market pullbacks. Given the improved outlook, we are increasing exposure to government bonds. The purpose of this portion of the portfolio is to continue to reduce volatility in your portfolio, but with the aim of providing a higher return than what is available from cash. Government bonds also provide liquidity and can be called upon for short-term unexpected cash needs, and can be powerful in rebalancing the portfolio when shares suffer a pullback. Then we are holding a long-term secure portion of the portfolio with an allocation to investment grade bonds. These form of investments are not as secure as term deposits and government bonds, given they carry a higher level of credit risk. But if managed appropriately, research indicates that for long-term investors can have a high level of confidence that they will outperform cash and government bonds over 5 and 10 year timeframes. Investment grade bonds are currently looking reasonably attractive on a global basis, so it is believed there is a benefit of taking the extra credit risk in the portfolio. However, we are avoiding Australian credit because spreads are essentially the premium paid for taking the higher credit risk. They have compressed to all-time lows. So better value does exist overseas, and we are investing the portfolios accordingly. Finally, a reminder that unit prices for managed funds drop on the 2nd of July after the payment of year-end investment distributions. So you may see a drop in the value of your portfolios from 2nd of July until the distribution is received into your investment account in mid-July. That's all from us for today. As always, we would appreciate any feedback on content you'd like to see in the community. Thanks.